Good evening, everybody. Anyways, tonight what we're getting is kind of a lot of feedback that people want more option strategies. Um, so tonight we're going to kind of start on that process, and again, we're going to do the spreads of why spreads are advantageous. So some of this will be very elementary to some people, but trying to make sure that everybody understands what a spread is. So that's our next slide. What is a spread? And a spread is basically a spread position is entered by buying and selling equal number of options of the same class on the same underlying security, but with different strike prices or expiration. Now, that's the total definition of a spread. I usually try to keep my executions at the in the same time frame, not trying to cross over. So Lee, if you hate spreads, this is probably going to be boring for you, because I've made tons of money using spreads, and I'll show you why. So what's the most important criteria for trading options? This is what people kind of lose in the mix. They want to trade options, so they forget the underlying basis. And that's what candlestick analysis greatly improves our probability. This is leading up to the pivotal cash bonanza, yes. So this is what we're kind of leading to with all this. Yes, that's Robert said it. This is how the pivotal cash bonanza has been established. So it gives you the direction of the move, which is high probability, and also gives you the timeliness of the move. This is where I have made tons of money, is knowing exactly when to be buying a call or a put, and not the direction, but the time that direction is going to start moving, and also knowing what the magnitude of that move is going to be. So we have very good buy setups where we can see when a breakout is occurring based upon a candlestick signal and a pattern breakout, or one of our candlestick patterns. Again, showing that there's a J-hook pattern in progress. So we could be buying right here, knowing what our next price move is going to be. So when we understand what our direction is and what the timeliness is, then we've got elements that create very good, high probability, better risk situations, knowing what the spreads are. So if we know that we have wave 1, wave 2, wave 3, and our first wave is 14 points, then we're kind of calculating that our next wave is going to be 14 points or somewhere in that vicinity. So why would they, knowing what our upside price move is going to be, whoops, did I skip one? Oh, wave 1, wave 2, and we know what the pattern is. You know, we have a J-hook pattern in progress. And that J-hook pattern is being illustrated by the fact that we have a bullish Harami and then a gap up. No, I'm not talking the waves as in Elliott wave. Elliott wave is a whole system or a whole process of trading the waves. We're only trading based upon what I usually have: wave 1, wave 2, wave 3. Because when wave 3 is over, based upon wave 1 and wave 2, my trade is over. I'm going on to look at something else. I don't care whether there's a wave 4, 5, 6, 7 or a ABC counter. We're just looking at the 1, 2, 3 wave, and we can identify when wave 3 is starting based upon what candlestick signals we're looking at. So the most important factor is why a spread versus a straight call position is the math and the risk. First of all, our price trend analysis We want to figure out what the best math is for that trade. Everybody thinks, oh, this stock is going up. I want to buy the calls. That's probably true in maybe 20% of the time. Most trades, you either have a good spread, whether it's a debit spread or a credit spread, that has a lot more advantages. So whenever I look at a debit spread, I'm looking at a trade that's going to produce 2.5 to 3 times the return of what I paid for it. So that boils down to, and the reason I have 2.5 to 3 times, a lot of people say, well, what about 50-50 if you're right most of the time? Because of the elements that we have to put up with in buying options. First of all, we're buying on the ask side, and we're selling on the bid side. So we've already got that bid-ask spread against us. We also have to worry about our exercise price. A lot of people are asking, well, what price, which ones do we buy? And the exercise price, as far as a definition is concerned, is the strike price. And there used to be that they were in increments of $5 on the higher price stocks and down to $2.50 on the lower price stocks. But now, and that was back in the old days, and I can't even remember when the old days were because I've always traded options. But now they've broken it down to where you can buy it on the dollar increment and even down to the 50-cent increments. Expiration date, that's the date that the options are going to terminate, which is usually the third Friday of every month if you're buying the monthly options. Now they've got the weekly options. Now I don't pay too much attention to the weekly options just because of my schedule. I don't have time to watch that short term of trades. So I'm usually looking at my chart to evaluate what my best option strategy is based on a monthly option. Now that doesn't rule out looking at weekly options. And that still kind of boils down to how much time do you have to allocate watching the trades. In my case, even though I'm sitting here all day long, I've got so many things going on and so many other trades that I just don't mix a weekly option trade in with it. The other factor that helps us out quite a bit is time decay. And time decay is very simple to explain. That if we're this far out and this is expiration, the longer that or the further we are from the expiration, the more time that price has to either go up or the opportunity to go down. So out here, if I'm buying a call price for $3, that's because if the stock is trading at 50 and I'm paying $3, that's because I'm anticipating it going up much further so that I can buy that piece of paper, that option, to buy that stock at 50 when the stock's at 70, or sell that piece of paper at $20 at that time. Because there's a lot of time. But as time gets closer to our strike price, there's less time for it to have that big move. So if I bought the calls at $3 today, and there was 4 weeks to expiration, and the price kept moving sideways, the price of this call is going to keep diminishing because there's less time for it to move up in a upward direction. Same scenario on the put side. If we think the stock is going down and it's trading at 50 and we buy the puts at $3, the further it gets closer to the expiration date, this premium, this $3, will go back to zero, because if it's still trading at 50 on expiration day, nobody's going to pay you any money for the calls because they can buy the stock right at the market for 50, or nobody's going to pay you any money for the puts because they can, because it is trading right at 50. How is time decay helpful? Wouldn't no decay be better? No, we're getting to that. And time decay is involved in option trading. So so when we can take advantage of the candlestick signals and have the expected results, the option spreads become a much higher probability trade situation. And that's because, go right back to, we know the direction of the move, the timeliness of the move, and the magnitude of the move. So if I'm looking at a stock that's trading at 50 and the target is 55, and I'm buying, and this one we wrote up a while ago, buying the December calls at $2.50, and it does hit our 55 target, that means those calls are now $5, or we've made a $2.50 profit, or 100% gain on that stock price. And our break even on that trade was $52.50. If we paid $52.50 for that option when the stock was trading at 50 and it went to 55, well, if we paid $2.50 for it, it had to go from 50 to at least $52.50 at expiration just so we could get our $52.50 back. So that's our risk reward factor. We're paying $2.50, hoping the stock will go to 55 from the $50 area, and we make 100% profit. Now, if we did a spread, and we could see that if we bought the December, I think that's the same screen. Here it is. If we do a spread and we buy the December 50s for $2.50, and let's say the December 55s were selling for $1, but that's the target we think it's going to, we can be buying the December 50s, which is going to cost us $2.50, and we sell the December 55s, which means we're putting $1 back in our pocket, so our net is $1.50. Oh, James, we'll have to look at Citrix. We've just been on Omnovia for so long. So we've got $1.50 in that trade. Now look what happens to our leverage. If the $55 target is hit and it goes to $5, now we've made $3.50 on that $1.50 versus $2.50 on $2.50. So our percent profit is now 275%. Isn't your $1.50? Yes, we're paying $1.50. And so now that $1.50, if this stock goes to 55 or greater, the net difference is still going to be $5. If it goes to 57, the options that we bought on the Decembers are now going to go to $7, but the 50s we're going to have to buy back. The 55s we're going to have to buy back for $2, so still a net difference of $5. So if that stock goes to anything greater than 55, we've got a 275% profit instead of 100% profit. And on top of that, our break even now is lower. So instead of it having to move to 250 just to break even, it has to move to 51.50 to break even. Won't the stock get put to you? No. If it does, you've got stock that you're going to call from somebody else to transact that trade. So normally in a spread situation, you're not going to have stock put to you. Would you ever buy back the calls early? Yeah, you can always close the trade whenever you want to. There'll be a lot of times where, let's say, for example, we thought the stock was going to go over the next 2 weeks up to 55, and then all of a sudden 2 days later it's trading at something is announced and it's trading at 57. Well, that spread is probably going to move up quite a bit, and you just close it out then. There'll be times where the profit left in the trade isn't worth the wait all the way to expiration. Okay, I'll try to, let me try to get through all this. Let me see. I give up on this presentation. All right. Is it 2:33? Maybe so. Might be 2:33, but it's still a heck of a lot bigger than the 100% profit. All right, so what's the most important criteria of a spread? Again, it's first of all, it's the analysis. What is the market trend? Where is the market trend? Are we buying stock up here, or are we buying a spread when the Dow's down here? So we can see that the trend analysis on any market index is easy based upon candlestick signals and our simple criteria of using stochastics and using everything else that helps us analyze what the market trend is doing at the time. So obviously up here, we're not putting on bullish spreads as stringently as we would if we saw something like this or something in this manner. Are you going to show us what you use to buy or sell market direction? Oh, that's just the analysis of the market direction itself. If the stock down to 40, do you sell what spread to balance out? What if the stock down to 40? Oh, Joe, if the stock is heading to 40, apparently your analysis of the chart should be that you shouldn't be in that trade anymore. You close it out. There's a lot of people that say, well, if a stock goes down far enough, should you double up? No, that's usually telling you you're doubling up on a stock that you should have analyzed a long time ago that was not heading up. So instead of selling it, you're just trying to buy more at what you think is the bottom. So is there a time I ever double up on a position? Definitely not. If I'm buying based on a criteria that tells me whatever I'm buying is supposed to be moving in this direction, and it turns around and goes the other way, I get back out of the trade. That's the old process of cutting your losses short and let your profits run. How do you use credit spreads? John, I'll get to that in a bit. All right, so anyways, if we're making our trend analysis and we can see what the trend channel looks like and we can see if there's a breakout level, at least we know we should be watching to see what happens to what the market is doing at this level to see if it's going to go to the next resistance level. So we've got a much easier analytical factor just analyzing what the trends are going to do or the market trends are going to do using candlestick patterns. And that's what kind of leads into whether you should be buying call spreads or buying put spreads. Again, anytime you can see what the trend is, that's one more factor that's going to help put the analysis of what you should be doing. What is the price history? Is it bouncing off of a trend channel? And this is what the Japanese race traders always tell us. Let the market tell us what the market is doing. I got killed for so many years me trying to analyze what the market is going to do or which person I'm listening to, whether Joseph Granville said the market was going up or going down. There's only one right analyzer out there, there's only one right evaluation of the market, and that's the market itself. And using the candlestick signals gives us a much more clear impression of what's going on in the market or evaluation of what's going on in the market. So when is a spread not viable? It might be when we're working on a pattern that the upside potential is so great that we don't want to be putting on a spread. That if we can recognize that we're in a fry pan bottom and that our upside potential is basically this, there may not be a point to put on a spread, because what are we expecting coming out of a fry pan bottom? A very strong price move. Why do people fail when using candlestick patterns? Because they're probably anticipating that the candle patterns are always going to tell you that the market or whatever pattern you've discovered or are trading is going to go up, instead of letting the chart tell you whether that pattern has failed or not. Bill, sometimes you have to close out, log out, and log right back in to get rid of the echo. All right, so here's a case where in something like this, it might not be worth putting on a spread. So the example might be that if the stock is trading at 50 and the target is 55, that if you're buying the December 50s for $2 and you're selling the December 55s for 10 cents, yeah, that still fits into our criteria that we're less than $2 to make $5. However, is that 10 cents worth the eliminating your risk, your upside potential, that instead of it giving you going from whatever $1.90 to $5, that maybe the $1.90 is going to go to $15 instead of that 10 cents that is going to limit your upside potential. So that 10 cents may not be worth putting on a spread. That you're better off just buying the calls outright. So again, the analysis is, what is the price history and what is the logical potential target? And this is where time has two elements to it. First of all, your timing. When is the best time to look at a call spread or a trade? Is when it's right at the breakout point, that it's breaking out of the pattern. That's our ultimate timing. Let's see what else. So this was kind of showing that the timing on this was, what did we have right at the breakout level? At a fry pan bottom, and the breakout we had a doji sandwich. And what do we know about a doji sandwich? There's going to be more upside. What do we know about a fry pan bottom breakout? That there's going to be more upside. So in this case, we bought the calls for 47 cents. And we sold out here because why? What's our other criteria for analyzing a trend? The further you move away from the T-line, the higher the probability it's going to come back and test it. So this is a perfect time to take your profits, because the probabilities now say it's at least coming back to the T-line. Is it going to hold? Have no idea. Is it going to do a J-hook pattern? Have no idea. But when we take our profits, knowing the probabilities are it's coming back to this level, we can always reestablish our strategy or call strategy based upon how much time we have left to expiration, and whether so our next strategy might, instead of being a straight out call, might be a call spread, because by the time it gets to expiration, it may only get up to here versus this whole move. So a spread would be better based upon how much time we have going into expiration. You need to know the moving averages. The moving averages are, the blue is the 50 simple moving average, the gray is the 20 simple moving average, the black line is the T line. This is the most profitable trading indicator using candlesticks that I've come across in the last 40 years. And that basically says if you see a candlestick buy signal and a close above the T line, you stay long until you see a candlestick sell signal and a close back below the T line, with the caveat that the further away you move from the T line, the higher the probability it's going to come back and test it. So Again, this is using the example of this is the buy point. This is where the breakout is. This is where on knowing that a doji sandwich is a positive open after a doji right at the breakout level. And this was to give that example of, do we always get huge moves on a breakout? Definitely not. But it puts us in positions where the probabilities of being in these moves are huge in our favor. What website you recommended for stock charts? Oh, I use Metastock. I use Thinkorswim or TCNet for my scans. These charts all came from CQG, which I don't recommend because I pay about $1,100 a month for these charts just because the graphics are good. So again, the breakout timing is one element, and then the timed expiration is the next element. So most of the time when I put on a spread, it's usually 2 to 3 weeks before expiration. And the reason for that is the maximum profit that you're going to receive from a spread, if it works correctly, is on expiration day, because that's when there's not going to be any premium left in the one up above or the one down below. So you don't try to get into a spread too far out in front of the expiration, because if the stock starts moving, more than likely, if the stock starts moving up big, the percent move is going to be in the higher priced strike price than the lower strike price. So if you just sold a 50 and bought a, I'm sorry, if you just bought a 50 and sold a 55 and the stock all of a sudden starts running, more than likely the 55 is going to move up in a much faster percentage than the 50, because that's why people are buying options, is for the leverage of at the money or near the money calls. Is the option trading, is your strategy, majority directional, long or short, or spreads? Gig, I would probably say 60 to 70% of my trades are spreads, probably, and debit spreads. Probably a small percentage is credit spreads, because the profit from a credit spread is usually very small, but the percentage of probabilities that it's going to work is extremely high. And then maybe 20 to 30% of my trades are outright calls or puts. So right now, I'm just starting on buying November spreads, because we're about getting into the 3-week time frame to expiration. Staggered spread, yes. If I think a stock is going to move based upon a, let me see if let's see, this is when is the maximum pricing for the results of a spread? That's on expiration day. So if I see something like this, where I know it's breaking out, yeah, I might do a staggered spread, meaning I'll buy the one call in the morning and sell the upper call later in the afternoon, so that my, and that's based on a pattern that I know is going to be breaking out. And what that does is that means the spread amount is much smaller. So you give up something, because the calls that you bought in the morning are already up in price. You've got some profit to it. And then when you sell the other call against it, you've already basically given up that profitability. But your spread amount, instead of maybe being $2, might be only $1.20 on the spread. So that means the leverage becomes that much greater. The pivotal cash bonanza hasn't been trading a whole heck of a lot, especially over the summertime, because, as you saw, the markets were just sloppy. The risk-reward factor wasn't all that great. you're starting to see them pick up a little bit more now with the market starting to get more trend to it. So again, the expiration date is important because that's how much time you have to that date, and if it's not too far away, your spread is going to be maximum there on expiration date or very close to it. Taking profits, that's also how much time do you have to expiration. So if I bought a call spread and I paid $1.80 for it, expecting it to go to $5 in, let's say, 3 weeks, but in the first week there's a big move and the spread goes up to where it's now worth $4.60, I've got to decide, is it worth holding on to for an extra 40 cents over the next 3 weeks? Or am I much better off taking the profits now and moving on to another trade situation where my expected percent return is going to be much greater than that 40 cents on a $6 price? So here's kind of my schedule. If I got 4 weeks or greater, I'm usually buying straight calls or puts. On the shorter trade, if it's 2 to 3 weeks out, I'm going to be buying debit spreads. Because again, when we get to the expiration date, that's going to be my maximum profit. The final week, I'm usually doing credit spreads because the premium on either puts or calls are still going to have, if you know what the direction of the price is moving, your profitability is not going to be tremendous, but your percent of making a profit are going to be extremely strong. So there's always the premium that is still left in the calls or the puts going into the final week, but that's the time to start doing the credit spreads because they're such a high probability trade setup. So there's going to be times doing a credit spread. For example, this is selling a put spread, which puts $2, and this is back, we were trading this on Apple a while back. If you're buying or you're selling a put spread, remember, selling a put spread is bullish. That means you're selling the spread, putting that money in your pocket, and let's say this is the expiration date, not too far away. Well, because of the premium in the puts, because we anticipate the price moving up based upon a breakout of this this pattern, and stochastics are coming up, that we're putting $2.30 in our pocket, and our break even in this case is down here below where we've bought it. On the other hand, if we were buying call spreads, to make that $2.30 with this as your expiration time frame, this is your break even up here. So buying a call spread may not make sense because the numbers are too big, or you're still working against yourself where putting $2.30, this stock has to go up quite a bit to make that $2.30, where the put spread, it didn't have to move at all for you to make that profit. So here's a case right now with Apple that as long as we can identify what the pattern is, which is the fry pan bottom, and then the J hook, that if we knew what our potential target was right here, we could be buying a spread, which would be probably a lot more profitable than just buying the calls outright. Because obviously with the calls, you got the premium built into it, which meant it had to go up a certain amount of price just to break even, where the spread kind of diminishes that quite a bit. The major advantages of a spread is, number one, you can calculate based upon candlestick charts where your probable target is. So you know the direction toward the target. And when you're buying one call and selling the other, you've got less money exposed, and the percent move is much lower for you to make a good reasonable profit. So with that, I had something. Oh, so this is the win strategy that we put on today, which was that we saw the doji. Notice the pattern. Failed at the 50, pulled back, started back up, but this, remember, is not a reversal signal. That was just an up day, but it told us they might be buying, pulled back a couple more days, and then did a bullish engulfing signal. So when you analyze this whole chart, what are we seeing? The stochastic starting to curl up. We started seeing some buying, but it wasn't a signal. It pulled back, and then there was a signal, and then the bullish engulfing signal that closed just above the T line. So what did we want to see today to tell us that the bulls are still in control? We wanted to see positive trading. In this case, they gapped it up above the 50-day moving average. Now, what's our pattern expectation tomorrow? Well, if they open this positive, now we've got a bullish doji sandwich, and if it moves up the same magnitude as this candle, that's going to make for a good trade. Remember, we have the advantage of knowing that if they open this positive tomorrow, the probabilities are pretty strong they're going to take it up this same magnitude. If they do that, you can put on the trade with good confidence early, or you could put on a spread. So this is what we have to kind of calculate. And if it opens positive and trades positive, what's it telling us about our overall pattern? We've got a wave 1, wave 2, wave 3 J-hook pattern. So there's our first target. It's probably up here into about the $77 range where it peaked out before. That wouldn't be outlandish. And then what's our next target? Well, if this was a 25-point move, 25 points from about the $70 range takes us up into the $95 area. So what's the best strategy here? Well, you could be buying the calls. Whoops. Buying the November 70 calls for $375. If it goes up to 95, obviously that price move is going to be up to $25 or a 667% profit. But what do we have to assume for it to go all the way up here? We've got to assume that the market is going to stay strong for the next 3 or 4 weeks to allow this price to continue upwards. So the other alternative is that we saw that one is buy a vertical spread. We're buying the 70s and selling the 75s. Our price is $1.81. What's that tell us about our risk reward? Well, first of all, it takes us where our $1.85 goes to $5. That's a $3.15 profit or 170 profit. Not anywhere close to the 667%. But what factors do we still have to take into account? We know that this is probably a viable target before it hits resistance, and it could do that in the next few days. We've been in a steady uptrend in the market. We can kind of assume it might be still enough time for this to reach the $77 range. For it to go to 95, we have to make a whole completely different assumption, that the market is probably going to stay strong for the next 2 or 3 weeks versus, let's say, just the next week. You could sell a put. You could do that, Cassia, but I wouldn't sell a put this far in front of expiration. I'd rather wait closer to expiration to sell the put because your upside potential is fairly strong, and you're limiting your profitability of selling a put by the amount of money that you put in your pocket from that selling that put. on which day you place the trade exactly. I bought some calls near the close today because it was still trading positive up above the 50 with the anticipation that the market consolidated today and we still had more upside. Or if it opens positive tomorrow, you can be buying because now we know that we got a doji sandwich in progress. How much of a bigger picture do you consider in the candles? Casino sector is down. How much of the bigger picture do you consider? Dennis, that's a whole different evaluation of what we're looking at. Yeah, you can analyze which sectors are acting the strongest or the weakest based upon what the charts are telling you. So back to this one, my profitability is only 170%, which isn't bad, but my risk factor is much lower. The stock only has to go to $75, and my spread still produces a decent profit. And you can also use the candles to, if you're really a high, when I say speculative trader, a lot of people say, well, do you buy going into earnings? And this is a very simple evaluation. What were they doing in LinkedIn going into the close on the day they were reporting earnings? They were still buying. This is a very bullish chart. Then I guess after hours it was trading up here. Same scenario with Starbucks. Starbucks is trading down on the day going into earnings. That told me, because I don't have an extensive research staff at my fingertips, that the big money was starting to sell off going into earnings, and I think they've gapped this one down after hours. So you get a high probability based upon what's the smart money doing going right into the earnings, because usually if somebody's buying going into earnings, they know something a lot more than we do. Or if they're selling going into earnings, they know something more than we do. I just let the chart tell me what to do. Would you also buy a long call 216 on win? Jeff, no. I wouldn't go that far out, because the further you go out on a chart, let's see which one we had up here. We're assuming, forget which one it was, this one. We're assuming that this is going to continue up for the next 2, 3, 4 months. We have no idea. I usually try to stay within the first reasonable month of options expiration, because we're looking at what's happening right now. So I'm looking for I'm looking for what the price is moving right now. So I want to get as much leverage as possible, which is obviously buying the closest expiration. Now, if I think there's a big price move coming based upon a chart pattern, but we're only a week and a half away from the closest expiration, yeah, then I may flip out instead of buying one that's going to expire in 10 or 5 or 7 trading days. I might go out to the next month. But I'm using leaps are more for the long-term trader, and most of my trading is swing trading. Do you ever use back ratios start existing short legs? Thomas, I wouldn't know one of those if I fell over it, so apparently I don't. So anyways, all right, I'll take on questions, but first of all, Pat wanted to let you know that there is a, this is the Pivotal Cash Bonanza. Now, the advantage to the Pivotal Cash Bonanza is you can sit there all night long trying to figure out what the best strategies are for the charts that you're looking at. The guys that we've got doing the Pivotal Cash Bonanza for us have been trading for years, so they are taking the candlestick signals and patterns, and they're applying what is the best trade. So a lot of people ask, well, what strike price should I buy? Should I buy in the money, out of the money? They're taking that all into consideration for you. So, yeah, they're Bexy now, and there is a. Oops, I guess I can do this. There's an unannounced bonus with this right now. That if people, I think you've got. I think this is only open for the next 24 hours. That if you sign up for the Cash Bonanza, which is basically is them putting all the information together to trade the right options for the right pattern, so you don't have to sit there all night trying to figure it. This is where you just put let them tell you which strategy. They're doing all the calculations for you. And if you sign up with, I guess in the next 24 hours, you got a 30-day free membership to the Candlestick Forum, which includes our live trading room. So this is all kind of funneling back to the fact that candlestick signals and patterns produce not only the right direction, but the right timing, and you can pretty well calculate the magnitude of the move based upon how much juice you have left in your stochastics and what is the next resistance level. Somebody was asking earlier, or just Gmailed me, said if you're a member, does this you get the 30-day free trial? Yes, you get a free 30 days if you're already a member of the website. So with that, let me take on the questions on the win debit spread. You bought the 50 call and sold the 55. What expiration? No, I think on the win today I bought the, these are the Novembers, bought the 70s because the win is trading right around 69. I can figure this out. Win closed today at 69.90, so basically 70 bucks. So if you bought the calls outright, paid about 375. If it moves big, fine and dandy. If it only moves, let's say the market only goes up for another 3 or 4 days before backing off, at least you have the potential of coming up here another 7 points to this target. So this is the type of thing that you strategize on is you could buy the calls outright and then do a spread. So if it does fizzle out here, at least you've made a little bit of money on your on the calls, not very much, but your spread you've made a lot more money. Would you go out further on win like 72.50 or 77? If it makes sense, Mary, if the dollar amount, all you're doing is kind of speculating a little bit higher that the price is going to go higher. And so I think, if I recall correctly, I did look at those, and they were trading at about $1.68 or so on the 72.50, 77.50. So it all depends on what your risk factor is. That one I probably wouldn't be too afraid of to do either. When you say debit, does that mean you put again? No, that means that I've put money out of pocket. I bought the 70s. Let's see if we can go back. Bought the 70s. Let's say they did the spread where they got it for me for 370. And then I sold the 75s. So that meant that the difference was about $1. I think about $1.81 is what it was trading for earlier today. So no, I didn't buy a put. I just sold this call. I bought this one, which meant I put $3.70 out of pocket, and I sold this one, which meant I put let's say $1.87 back in my pocket. So the net difference between that is what the price of this this would be. Your risk return ratio is usually better with the debit, right? Mostly because you've got more time. Your risk factor on a credit spread in that final week is very low, because if the price is moving in the direction and it's moving away from the put, let's say you sold a put spread, which is bullish, yeah, and the price is still moving up, that means that premium was all going into your pocket. It wasn't very much, but the probabilities was that the price would have to have turned around and gone down dramatically uh, for that the credit spread to lose money for you. Let's see. I'm scrolling up here. What email? Phil, let's see. What was Phil's question? Phil, yeah, that was a whole different topic. You can analyze which sectors are moving positive or negative just on simple candlestick analysis. Remember, candlestick analysis is just the graphic depiction of what's going on in investor sentiment. So it boils down to, you can analyze which direction the market is going, the market indexes. You can analyze which direction the sector is going. And then you can analyze what's going on in individual stocks. So if you want to put all the stars in alignment, if you know the market's heading up and you can analyze the sector that you're looking at is heading up, then you can go and analyze which stocks have the best chart patterns, and that's pretty much putting everything in your favor. You give exit and exit signals for stock. Yes. We put out 2 or 3 stock picks every day, not so that people have stock picks, but because the analysis should be telling you there's a reason for that or recommendation. And if the price, usually I say if the price moves up through X, that's when you want to be buying, because that's confirming the price pattern. Again, that's not so that everybody has stock picks every day. It's so that you have a constant learning process of why that chart is being recommended and what your upside or what all the parameters are on that, visually analyzing that chart, made that a buy recommendation. You consider implicit volatility buy options? No. Because coming out of a fry pan bottom, you wouldn't have had very much volatility for the last 2 weeks, 2 months, 2 years. Now all of a sudden the pattern is breaking out. It has nothing to do. So it's not very little. I don't do anything with what they call the Greeks, because we're looking at patterns that are based upon human emotions that might be breaking out of a dull pattern or a dull trading environment for the last 3 months. Now the fry pan bottom breakout tells you there's going to be a very strong price move. Let's see. Yes, Fridays. If you're Fridays is usually the last day going into the final week that you want to start shifting some of your trades, because your premiums are going to be a lot lower, or the price of those options is going to be a lot lower, because on Friday you still have a full week till expiration. On Monday, the psychology is, oh, it's going to be expiring this week, so the price goes a lot lower. The PCB trade are traded by professional traders that we have trained over the last couple years to analyze the patterns and signals that we would be doing. So instead of me trying to sit down every night and analyzing every single strike price, I mean, we do that some, but they do it professionally, where they pick out the best, I want to say, the best priced option to go with the strategy that or the price movement we're looking for. Do you have any recommendations how much percentage to be for options? How much do you use it? It's percentage. Do you have any recommendations how much percent to be for? Nick, I've got a very simple money management strategy, which is if I've got, say, a $500,000 account, I'm only going to have 10 positions on at any one time. So each position is going to be a $50,000 position, because unlike Susie Orman that says you should never have more than 4% of your money in any one position, that means you have to have 25 positions out there. And most money managers have a hard time following 6 positions, let alone 25. So I have 10 equal dollar amounts, and if I was going to combine options with it, then I take maybe one position, a $50,000 position, and I might break that one up into 3 or 4 option trades of, let's say, 12,500 apiece. So, yeah, there's no mathematical reason for that. It's just a very simple process for kind of keeping the risk factor. Each position is big enough that it's going to affect your portfolio, and each position is small enough that it's not going to kill your portfolio if something drastic bad happens. Whoops, I went the wrong way. How many trades does your program provide roughly per month? Oh, I had a number. I thought it was, they're cranking back up towards about 2 or 3 positions a week. Oh, William, we've been working with them already for over a year. Yeah, so they're people that we work with. And I don't even know what entity they traded from before that. Brand new to options. Will this work for me? Steve, the first thing I would do is learn how to use the candlestick signals itself, and then step into options once you become familiar. First of all, you need to become very familiar with analyzing where or which direction a price is moving and how far it's going to move. DK, yes, I'm still in BABA because that's still in that process of doing a J-hook pattern. So I've got some big profits in it. And as long as it's right now it stays above the 200, I'll hold on to it. Only buy and call. What should be stop loss in that case? The underlying stock. Your options are nothing more than a method to buy the underlying stock. So your analysis is still completely on the stock price. So when you buy a stock or options on a stock, it's because it's doing a price move or signal or pattern that is favorable. That is a candlestick reversal signal or a candlestick continuation pattern. If it breaches that, that's when you close the options. So it's the stock that you base your stop loss on. Let's see. 20 cents isn't much for 70 versus 72. 20 cents. Oh, yeah, that's, again, but now you're, again, the higher you're going up from 72.50 to 77.50 versus 70 to 75, it's still the price move still has to move in that direction and get to that level. What triggers you to get out of a trade? Close before the T line. Do you try to manage trade to avoid loss? Yes. And that's all simple. Again, that's what we do in the chat room every day, is analyze the charts and say, all right, this is where you want to stay in it, and this is where my stop loss would be based upon it coming back through the halfway point of the candle that told us that the bulls were in control, or the T line So that's all part of that's a whole different session. And those are the type of sessions we do on nights like on a Tuesday night or a Wednesday night for members, is we might do entry and exit strategies or stop loss strategies or how to scan for the best. So all that information is on our videos, but which are discount for members. But you get a much more clarity if instead of watching the video, we do it live. That way you can be asking the questions right at that time. Let's see. Baba. Apple moved higher today. Any candlesticks on this? Yes, that's the chart we were looking at on Apple. Yeah, that's Apple today. So based upon this pattern and then knowing what should come out of that pattern, in this case, kind of a cup and handle, that when it opened positive from a doji, then we could estimate whether doing the spread was better than just buying the calls outright. Let's see. What happened when your debit spread strategy goes against you? You close it, just like you would the stock. Remember, you're buying the strategy based upon knowing what the direction of the stock is doing. If it starts going against you, you close it out and move on to the next one. Do you buy and sell the two legs of the spread at the same time? Most of the time, Padma. However, which one was it? That wasn't it. That was. Let's say we anticipated. Let's say we wake up tomorrow and the pre-market futures. That's not it. The pre-market futures are up good, and this stock is opening positive. This is win. And you set up your call spread. Let's say it was 70, 75. Well, and if you knew it opened positive and you could feel or knew that the doji sandwich was going to take you higher, you could buy the 70s in the morning and sell the 75 later in the afternoon. So instead of your difference being $1.81, you might have been buying this at a lower price and selling this when the price was higher. So your net difference instead of $1.81 may have been $1.42, for example, which isn't all that great, but percentage-wise, that means your break even is lower and your percent return is going to be that much greater. Vince, if you bought it, just email Abraham at candlestickforum.com. He'll make sure you get the 30-day free trial. Let's see. Rama, we probably won't be doing the stocks tonight because there's usually too many questions on option trading. And the reason I'm kind of pushing option trading with a professional group to do the trades is because even with the best, and I figure I give myself credit as being a pretty good analyst of what the market is doing, but when I go to the options, I probably don't spend as much time as I should saying, all right, should I be buying the 70s or the 7250s or the 75s? What makes the most sense here? That's what these guys do. That's what they do all the time. So where I might be saying buy the 70, they might be saying buy the 72s because that's priced better. Would you just be discussing scans for stocks and ETFs that are prime candidates for making an abrupt pivotal change? We do that every day, Mart, in our chat room. I put out stock picks based upon which chart patterns have the highest probabilities of not only moving up, but moving up with great magnitude. And that's why I've done videos on the on quantifying things like the best friend, which is the doji in the oversold area gapping up the next day. That not only is it going to produce a high probability of an uptrend, but a very strong uptrend. And we got the left-right combo, or the doji sandwich, the fry pan bottom breakout, or knowing what a J-hook pattern, where the entry strategies are for those with the highest probabilities of moving. Sco, you should be receiving something. Just email Abraham at Candlestick Forum. I've given them the criteria because they're trading stocks that I wouldn't necessarily trade because they're slower moving. But they also do two things, and they might be trading bigger stocks than I would, meaning they might be trading the IBMs. They're not trying to hit the home run like I'm trying to do. They're making sure that if you're buying a call for $1.43, they tell you to close it out if it at $1.10. But their expectation is that that $1.43 should be going to a $3.20. So they're immediately telling you when to close out that trade. Oh, I'm sorry, Scott. Sorry about that. What kind of performance have you have on your recommendations? Ramesh, I have no idea what the performance is, but let's put it this way. Before candlesticks came along, I was the worst investor in the world. I was a stockbroker for 8 years and got out of the business because I realized the brokerage firms had no more idea what made stocks go up. Their idea was buy a good company, just hold it long term, which, as you saw in 2008, that wasn't a very good strategy. But I can tell you this. I've got a nice estate here in Pennsylvania. I've built a barn for 25 classic cars. My house is full of antiques that I've now have to get rid of. And I probably don't ever have to work, ever work a day in my life from here on in, because candlesticks turned me from being the worst investor in the world to where I can consistently pull money out. So I don't know what the rate of return is on. And I can't tell you that because what I'm trading might be much more speculative than somebody else, or much less speculative uh, than somebody else. Let's see. Dr. B, we'll make sure everybody gets responses. Gold looks a little bit weak right now because it gapped down today. All right. I need sign-in information for. All right. Becky, do you want to type in Abraham's address, email address? Is there a program where we just follow your trades? Yeah, that's in the member, just in the member area. Again, our whole process is just to teach people how to analyze the charts. Again, we're not trying to, because when I recommend a trade, some people are going to scalp the trade, some people are going to swing trade, some people are going to be longer term investors, some people are going to buy options, some people are going to buy the stocks. So there's nothing out there that we're trying to teach people, this is how you do it. What we're trying to teach people is, here is the direction, and this is the signal that told us with a high probability that this is going to be moving positive. Now, from there, each person, and that's why we have so many speakers on. is because if you apply candlesticks to anybody's trading strategy, you're going to improve the probabilities and the visual assessment of that with much more clarity. Uh, what's the maximum number of positions in any? I usually only have maybe 10 positions open at any one time. That I can analyze 10 positions in a matter of in probably 45 seconds each afternoon. Gig, I probably have 40% of my my little trading account, which I can show people. As you can see, it's most of the time it's about 60% in options and maybe 40% in futures, but I'm usually trading those futures almost on a daily basis. Is there any history of performance available? Mark, not really, because as I say, there's so many trades. I guess the only thing you could really ask people when they that are members is whether they're making money with candlesticks. And remember, this is not a secret method. This isn't somebody telling you the secrets of how to make money in the markets. Candlesticks have been around for 400 years. So the only thing you want to learn about candlesticks is how to use them correctly. Because number one criteria of Wall Street is if something doesn't work, it disappears very quickly. We're just trying to learn or teach people how to use what the signals and patterns tell us correctly so they can establish their own trading. I don't try to give people picks just so they have picks. I want people to understand why those picks were being made so that they can analyze charts on their own sometime down the road. So they learn how to invest. PBCB, do you have scan codes for your setups that work? And RZ, there are scans already. TradeStation has all our formulas. Yes, the trades are, when they put out a trade recommendation, you'll get the email on it immediately. Lanell, you should be, I don't know whether they did a trade today or not. I know they closed out QCOM. How lot size of options matter? Lot size is based upon what your risk tolerance is. If you're used to putting $4,000 on an option trade, that's what you use for your option trade size. What is my typical out-of-pocket cost to trade options? One contract. Oh, I don't know, whatever the commission is wherever you're trading. Is there any program where Steve shares his own trades? Buda, I do, but it's in the futures area. When I put on a trade, they automatically put the trades in everybody's account. What is the lowest price you risk to trade options? What is the lowest price? Steve, I don't understand that. Oh, Mart, don't have that statistic either on what is the typical win rate on real trades. Because there are some periods in the market where 90% of my trades are all winners and big winners. Then there's other periods in the market where most of my trades are loser, but because they aren't working, they're closed out very quickly. So that's a hard one to answer. We're not trying to give people a trading program that they can get into based upon wins and losses. We're getting people into a trading program where the probabilities of being in the right trades at the right time are extremely high, And that's off a process that's been working for 400 years. When will you do a webinar on scans that you use? Jim, probably within the next week or two. Now that it's getting cold and yucky outside, we spend more time at the computers at night. This book, TC and charting. Jack, either TC 2000, Metastock is very good. I use Metastock quite a bit. And all the formulas for scanning are on TOS, TradeStation, NinjaTrader. They've contracted with us to use all our formulas. Would you do a spread tomorrow for tomorrow weekly expiration? Scott, I don't know, only because where are we on a weekly? Yeah, I'd have to look at the, and that's why I don't do the weeklies, is I just don't have the time to do the weeklies. Now, there are people in our option trading room that could probably give you a much better answer. Yeah, Don M, for example, is extremely good at setting up option strategies. Yes, Mouse. They'll tell you what price to pay for it and not any more than that price, and they'll tell you the price to sell it, not any less than that price. Now, if you see the option price and it's already past that price, they say just leave it alone. Go on to wait for the next one. Could you please give an example of option spread in combination of green flag, Nemish? No, I wouldn't know how to do that right now on this. What criteria do I tell them I want to scan? What criteria do I tell them? Oh, they're going to give you the, they've already got the criteria for using candlesticks successfully. John, I don't know what to tell you there. Oh, gold right now is backed off. As a matter of fact, it kind of did a kicker type signal to the downside today. Need in bucks, I don't have a recommendation. Don M, do you have a recommendation? When do you join the chat room? I try to come in. I usually come in for about 10 minutes right before the market opens, just seeing which ones are looking good. Then I come in around 11 or 11:30 after the market has settled down, and we go through chart analysis for about an hour, sometimes an hour and a half. I may come in for a minute or two during the day if we see something interesting setting up, and then usually for 30 minutes at the end of the day, about 10, 15 minutes before the market closes, and then after the close. This game is not what I was led to believe. Candlesticks don't seem to give direction. Lee, yeah, that's nothing I'm going to say is going to convince you here. Let's put it this way. Candlesticks have worked for me where I pull money out of the market every month. Not necessarily, Martin, on Apple today, because yeah, the green flag may not have worked on Apple, but the pattern, I mean, this is what we analyze every day in the chat rooms, is what pattern is this? This is a fry pan bottom, cup and handle. So today you could have been buying because it was breaking out here. You just knew that your first target was going to be here at the 200-day moving average. Do you ever finance an option call, make a slight profit? Well, speculators leverage this strategy. Oh, shoot. Finance an option call? No, I just pay cash for it, I guess. Um, oh, Hendry, I will get with you tomorrow. Um, let me know. I'll I'll Gmail you tomorrow. Um, let's see. I'm trying to read these as fast as I can. When do you join the chat room? Is that specific time or Pacific time? Yeah, usually come in around 11:30 after all the markets have settled down. That's when we do about an hour and a half. Lee, candlesticks might not be for you. We're not trying to push any program on anybody. We're just trying to teach people how to use something that's been working successfully. We're just trying to teach people how to use it successfully. Let's see. Thank you, Ramesh. I wanted back trade performances. Vince, we don't have back trade performances because we're putting on trades every single day. So that would be a mega. We're just trying to teach people what trades to put on, and we also teach people how to take bad trades off quickly to move on to the next one. Coming right back down to the basics of every analyst you talk to says cut your losses short and let your profits run, and they don't tell you how to cut your losses short and let your profits run. Candlestick signals do that very easily. Let's see. No, Penn, I've got 25 cars, all from the, oh, I just pulled in, I've had I have a 25 Hudson that needs restored that we finally just pulled into the barn today after a year and a half of it sitting out near the garage. I used to live in the Woodlands, just north of Houston. Right now I'm in Mars, PA, which is just north of Pittsburgh. Oh, Mike, I've made good money in the BABA calls because it was in a J-hook pattern. Oh, ITCI is still on a fry pan bottom. It backed off today, but it's been moving up nicely. So the longer they keep moving up, the higher the probability when they get to the resistance level, they'll break out big. Gig, thank you, and that's the whole point of all this is we're not trying to give people trades per se. We're trying to make it better for people to get in the right trades using options versus having to try to figure that out for yourself. But the underlying factor of a candlestick forum is once you learn how to use candlesticks, you can trade any market you want to. You can trade any strategy you want to. You don't have to depend on somebody else to give you that information. Okay, let's see. Ramesh, and this is unofficial, I would probably say that 70% of my trades are winners. Now, some of them might only be at 0.3%, but others will be 300%. And that doesn't necessarily mean I'm 70% winners all the time. I might go through 2 weeks where I can't hit my butt with either hand, and then the next 2 weeks I can't miss a single trade. But I know when the trades aren't working, I close them out very quickly because the candlesticks show me when when to be right back out of a bad trade and move on to the next one. Donald, the offer is the PCB, the Pivotal Cash Bonanza. But along with that, you get 30 days free trial to our website. So you can see what strategy they're using to trade and find the best trades for the options. But more importantly, the whole basis of our website is to teach people how to do eventually their own analysis. Thank you, John. Yeah, I'm not any great book writer, but I figured if I just put the information that was making me money, said it simply, that other people could do it too. Dick, yes, you can join them. The website is $97 a month. That includes a Monday night training session for members, Thursday nights like these where either a guest speaker or myself will come in and do training. Then the chat room is open all day long. I put out 2 or 3 stock picks every day. About once a week we try to do a live training on the best entry and exit strategies. Also how to scan for the best trades, how to set your stop losses, how to analyze what your best spread trades are. I mean, we go into all the topics that we have videos on. We just do them live so that you don't have to pay for it, and plus you can get much more comprehensive understanding with the question and answers going on right at that time. Let's see. A little confused. You mentioned win tonight, and the only QCOM close today was PCB. Oh yeah, I was trading win. That's what I recommended to the chat rooms today, the option room as well as the regular trading room. So that's my win is probably a little bit more speculative than what you will find they're doing over in the PCB, but they're following a whole different universe of stocks. Mine are probably a lot more speculative. Let's see. Lionel, yes, the formulas are all there on Metastock. Who sends out the Cash Bonanza? You get that right from the Cash Bonanza group. They send out the emails as soon as they have a option strategy set up. How do we get access to your future trades if we want to follow? You to just join the website. $97 a month, not excessive, and you'll find that you're probably getting well more than your money's worth. The T-line is the 8 exponential moving average, and it's probably the most effective indicator. Very simply stated, if you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close below the T-line. Travis, I don't have the live charts up, so I can't help you on JetBlue. How about for tomorrow's stops? I don't know. How do you join your futures program? Sam, I just put out futures recommendation. I'm usually trading futures all day long, so I just mentioned those in the chat rooms. We will be doing a session on futures, trading commodities, currencies on the futures, probably within the next 10 days also. Come on, Karen. I'm not familiar with options yet. Is this worth the cost just for stocks? Uh, you just want to join the website for just trading stocks. The PCB program is for those that want to be involved with options and using the candlestick signals and patterns to take advantage of those, but going one step further where we have a professional trading group that analyzes what are the best strategies for each one of those signals. Um, you can learn much simply from what is on YouTube. Sells itself, yes. And that's, I've been chastised many times around the nation when I'm giving presentations that we get to the end of the session and I just say, here's what we got. And everybody says, oh, you're not selling this very hard. My feeling is if you look at candlesticks and you see the rationale behind them, that if once you look at it and realize that it's just common sense put into a graphic depiction, there shouldn't be too much of a sell after that. It should just make sense. Oh yeah, I had the tractor out today, mostly because we were moving cars around. Then that's too technical a question. It doesn't matter which, with the dollar going down, which companies will be negatively affected. The charts will tell you that. Remember, the charts are the accumulative knowledge of everybody buying and selling during a particular time frame. So all the analysts out there and all the people that are actually buying and selling have already made their assessments. You're just looking at the chart to find out what that assessment is. Now, Richard, you don't have to put in any formulas. All the formulas are already locked in. All you have to do is apply them, stick them on your charting, and press your reset button or your refresh button, and it'll find the patterns that you're looking for. Richard, yeah, Zelienople is just up the road here. Oh, yeah, so that was 1925 Hudson. Unfortunately, it was too much work for me to work on. It needs full renovation. You hold live session trainings for your students at the Candlestick Forum? Yes. Yeah, we do try to do it at least once a week on top of the Monday night session. Do candles work in range-bound markets? It tells you that the market is range-bound, yes. So if the market's moving sideways, very simple scans. If you don't know what you're doing, it'll take you less than 20 minutes a day to find the best longs and the best shorts. So all summer long, I was both long and short because the market wasn't moving in any great direction. Then we made big money when the dumpling top, which is the opposite of a fry pan bottom, broke down, and we made as much money in 4 or 5 days as we did all summer long trying to trade the little ups and downs in the market with both longs and shorts. Um, no, the $97 that the PCB is a completely different program. $97 a month includes the chat room, the picks, plus I think we have about 1,300 pages of information on candlesticks on our website. Oh, Richard, I'd be happy if all my cars are worth uh, close to that. Pivotal Cash Bonanza is a pure option trading program that takes the candlestick signals and patterns, and professional traders trade that based on the signals. The Candlestick Forum is a learning process where the chat room is open all day long. We do training sessions at night. We put out stock picks. So it's teaching you candlesticks, whereas the pivotal cash bonanza is taking those stock picks and applying the best option strategies for each one of those trades. I find it remarkable when a confirming candle in the TSAR coincide at the same time. Okay, well, what trading analysis software do you use? I use Metastock. I use TC2000. I trade off the Thinkorswim platform. I trade off a Fidelity platform. I think we've got an account at Schwab someplace. Um, let's see. Okay, I'm still scrolling down. Bloomberg reporting tonight on when macabre revenue drop is narrowing. Remember, whatever news you hear is going to be reflected in the stock price. So there's often times where you see earnings come out fantastic and the stock immediately drops. That's because people thought the earnings should have been better. So candlesticks tell you exactly what's going on in investor sentiment. Where can I find the scan program on, do you know how I install it? Oh, yeah, Jim may have put them in. Okay, is it possible to review earlier recordings of early candlestick webinars? Yeah, everything's recorded. We record our Monday nights, we record our Thursday nights. Yep. Again, we record everything because we're trying to teach people how to use candlesticks. You have a group of investors, you manage their futures trade. We've got a service gig where it's with World Cup Advisors that you put your money in the account. When I put on a trade in my account, the trades go in everybody else's account also. Let's see. The scans are already in TOS. You use the same moving average day trading? Yes. The 200, the 50, this chart could be a daily chart, a monthly chart, or a 1-minute chart. They're fractal. They all look the same. All three books are on the website. Yes. A gig we do, we will probably here when the snow starts flying, we'll probably do a weekend training, doing the whole gamut of going from A to Z. That's usually a two full days. But if you aren't familiar with candlesticks, it kind of formulates everything all at one time. And then I do live trainings, usually what we call private trainings, usually with 4 or 5 people at a time, mostly at Cuca Lake up in the Finger Lakes of New York during the summertime. But we may do another one in the wintertime. We get access to the website with PCB for getting candlestick construction. Richard, right now, yeah, you got the 30-day trial to see whether it's something you want to do. Did you see August 24th coming? I don't know what August 24th was. In the Dow? Yes, that was the dumpling top breakdown. When it started doing the slow curve, we were short. And that's where we made in that 3 days. We made as much money in 3 days as we did in those 3 or 4 days, much money, and then the bounce back up to the T-line afterwards. Made tons of money with that. Okay, let's see. I have your first 2 books. Is your third book a lot better? The third book is oriented toward the emotions, how to get your emotions out of your trading using candlesticks. So that's the big bugaboo that most of us have, is you can have the best trading program in the world, but if your emotions are flip-flopping you like most of us do, and that's how you kind of let the candlesticks give you a much greater discipline, because the probabilities are always going to be in your favor when you use the charts. Okay, how do I get access to this recording later on? Yeah, I think that'll be emailed out to everybody that registered tonight. World Cup Advisors, Kat, you can email Abraham for that information. Okay, that's kept everybody way past bedtime. So with that, hopefully we'll see everybody in the chat rooms tomorrow. Thank you for showing up tonight. We'll see you later.